All right, welcome to the Big Skinny with me, Lou Bassanese. We're back in our Brooklyn headquarters, but somebody forgot to put the signs up. The Dodd man is not going to be happy about that. Maybe we'll get him up during a break. If you're wondering what the Big Skinny is all about, well, let me tell you. It's all filling and zero fluff for financial news. We've been called by a couple guests the sports center of financial news. I will take that. I love that. We're the highlight reel and highlight show of what matters in the markets. I like to think of us as maybe like Dave Portnoy and his pizza reviews, one bite, everyone knows the rules. Well, we got a few rules here for ourselves. We feature each week 3 key topics and investing trends that you need to be paying attention to, and we do it in a very straightforward format with one headline that you should probably ignore, one chart that has the key data that you have to pay attention to, and one investment insight that you should take and take action on it, because let's be honest, at the end of the day, we're all here to make money, and if we don't make money together, we're not gonna be spending much time together. I know you'll leave and then I won't have a job and everyone will be sorry. So that's the format of our show, all filling, no fluff. You can join the conversation and make this a choose your own adventure type story where you change the direction of the show based upon your comments. So we're live streaming on multiple platforms. Don't be shy to intervene and change the direction we go. And also don't be shy to go to our website, thebigskinny.com, and sign up for our newsletter. Scan the QR code on the screen or go to thebigskinny.com and sign up today. I'm excited this week to tell you that we have 2 key guests. Daniel Newman, who's become a fast friend, the CEO of the Futurum group, who has better insights than any into the tech space, which is extremely critical given the fact that all investing is tech investing right now. That's what I would argue. So he's going to join us to give us a preview about Nvidia's earnings and then the story beneath the headlines, because he has insights you won't find anywhere else. And we'll get into that, as well as talk about some of his favorite stock picks, because I've invested in some and I might give him a little of a hard time about 1 or 2 that didn't work out and one that is. We're going to follow that right up with a good friend as well and a former colleague, Will Rossellini from PatentVest, in an exclusive pre-release of their latest research as well, talking about how AI is really disrupting the software space. We'll touch on that with Daniel and then really get into the weeds with Will and what it means for investing in AI, software, and deep tech companies. And then, well, I got to bring in Dodd. You know, he always comes on at the end of the show, but he's got a new segment that we're going to launch with him. So Dodd, maybe it's time for him to just explain it to us. What do we got going on, Dodd, in the segment later in the show? Dodd's just not ready because he's just... Oh, we thought we were bringing in Dodd. We're not going to bring in Dodd right now, apparently. We were going to. Maybe he's out with Big Bird, hanging out around with Mr. Snuffleupagus and just slumbering around. But we do have a new segment. Dodd's got questions. He's going to get them answered for you. We're also going to be playing a game throughout this entire episode, so you have to pay attention. We won't reveal the game until the end. But without further ado, let's get to this week's rundown, where we're going to go through the 3 topics and trends that matter most in the markets. Let's get to the rundown. Coming out throwing punches just like Jerome Powell did on Friday, going from a hawk to a dove, saying we're getting rate cuts. And now this, right? Everyone was waiting on ready for the Fed chairman to say rate cuts are coming. We got that on Friday. So what's next for the markets? We saw a huge rip in risk assets on Friday. Today, not so much, a little muted response. Well, we're getting these headlines out of Bloomberg saying that it's not the Fed anymore, it's Nvidia. All eyes are on Nvidia, and it's the next market risk. But really, risk? Is Nvidia really a risk for the market? We're going to talk with Daniel Newman about that a little bit, but please, oh please, people, come on. Nvidia's biggest customers have already reported results, and they were anything but terrible. They're in fact very good. Most of the Mag 7 companies that are customers of Nvidia increased their guidance and their spending projections on CapEx for AI, which means more chips. But let's hear the bears out. Let's hear what the naysayers might be saying. Eric Briley here out of Stored Partners basically saying that Nvidia is critical to this market. Any signs of weakness, which I don't know how we're going to get it, is going to be a tipping point. It could be risk. Any signs of strength could set this market on fire. I agree with that. If Nvidia comes out and just rings the bell, better than expected earnings, better than expected commentary on China and business in China, then this market can rip roar, because here's what's going on. You look at these forecasts. Spending by big tech companies on artificial intelligence is only going up and to the right. This is not a slow trend. It's not a slow build. It's a massive acceleration. I do believe Daniel Newman's got some unique insights into what the real projections could be. So make sure you tune in for that in a few minutes. But look, big cap tech, big tech CapEx, my friends, getting tongue-tied, is only going to go up from here, and that means there's more plays in the AI space. Now, the concern is that Nvidia and the rest of the Mag 7 make up way too much of this market, that the market cap weighting in the S&P 500 index is now close to 8% for Nvidia. If we factor in Microsoft, I think it's closer to 15%. And the Mag 7 itself is 38-ish, 39%. So everyone's afraid that all these pink dots down below are not going to be able to deliver as good a results. And I say that's nonsense. They're delivering strong results already. We saw their Q2 results from the rest of the companies in the S&P 500, the unmagnificent 493. Report double the earnings growth than analysts were expecting. So all is in order, all is in good shape in the markets. What does that mean for Nvidia heading into the report after the close on Wednesday? Well, this week's money chart shows that we like big bets, not big butts, folks. I cannot lie. You look at the implied volatility for Nvidia coming up on this earnings report, and it's looking for a 6% move, either up or down. We've seen individual one-day gains for Nvidia of north of 20% on their earnings report day. So that's why so much attention is being focused on this earnings report. It's not only the growth in the AI market, but also the potential growth in the world's largest company. So the investment insight, it all comes down to Nvidia, but it doesn't all come down to Nvidia. The AI trend, whether Nvidia has maybe some soft commentary or a little bit lighter guidance than people expect, is not going to change the direction of this market for long term, and not going to change the direction of the AI trend for long term. So let's move along to the Fed FOMO, right? The Fed is going to cut rates and people are afraid of missing out. What does this really mean for us? Well, Ed Yardeni over in a Benzinga article gave an exclusive comment saying that he thinks this market is going to melt up from here, right? Ed Yardeni, if you don't follow his research, Yardeni Research is a great chart stack. I respect him, but I think he's missing the boat here, saying that it's just going to be a melt up that doesn't have any fundamental backing behind it, because the fundamentals are there, as I pointed out. But let's just talk about Fed probabilities. We went from a Fed that was not going to cut rates to a Fed that is absolutely going to cut rates. You look at this now, you pay attention to the blue line. That was a cut. It's now a 100% chance of a cut as we look into the September meeting. It's slowly dropped down from there to about 85%. But all odds are betting on a cut. I believe it's coming. What does that mean for us? Well, in this money chart, it's really cut on, party on, Wayne and Garth here, because this is what happens when the Fed starts a cutting regime after 5 to 12 months of pausing on rate cuts, in between cuts. You see, 1 month, 3 months after the initial recut, the markets are up mildly, down a little bit after 1 month, after 3 months, but 50 to 65% of the time, roughly, they're positive. But go all the way out to 6 and 12 months, we're talking about a market that's going to be up 91% of the time 1 year from now. So a year from September, we have very, very high probability that the market is going to be higher. What's that mean for us? Well, look around and we can look and see what the sentiment is, right? Investors still aren't overly bullish. In fact, if you look at the AAII survey, one of my favorites, you see in these red bars here that bearish sentiment is still north of 43 to 46% in most recent weeks. Historical average is about 33%. So folks, we get really bullish when people get bearish in the AAII survey. But what does it mean in terms of where you should be looking to make investments? Well, this chart coming out of Goldman Sachs is very instructive to me. It shows you what's been working year to date in the market. No surprise, top of the list, AI stocks, right? Utilities, total shocker. Boring old utilities rounding out the top two here with a 13% gain. I mean, that's amazing to me. But here's what's most interesting. Go to the bottom. Be a contrarian. What hasn't launched and ripped yet? Energy, right? That's a good place to be. We've been talking about it, underweighted, undervalued. Healthcare, I think we've got some names there that we're going to talk about today, but then also look at the RUT. That's not a rut row, that's the Russell 2000. Those are small caps. They had a rip-roaring day on Friday, rallying almost 4%. It hasn't been since the COVID days where we've seen the small caps rally so much. So, folks, buckle up. The Fed's getting ready to cut. There's going to be lots of opportunities. But where might there be some danger in this market? Well, see ya, SaaS. And I'm talking about software as a service companies, right? If you look at the new AI trends here, you may be figuring out that AI is threatening software companies. The latest headline out of Computer World says, does agentic AI spell doom for SaaS? Well, the fear is that these will kill off SaaS, and nothing could be further from the truth. Well, I have a guess that begs to differ, and I beg to differ. There are complete software companies that are built on things that can be built overnight now on AI. So what does that mean for these companies, right? It means they're probably going out of business. Or as Daniel Newman says, AI is eating software at an incomprehensible rate. Only a few SaaS names are investable. Choose wisely. We're going to talk to him about which ones we should choose and which ones we should avoid. But here, let me bring you some of the data that proves that this trend is unfolding as we speak. If we look at corporate-backed venture capital deals for software startups, so basically the companies in the business, insiders in the business, investing their own hard-earned capital in getting new software startups out of the ground. You look at this VC data going back to, I believe, the first quarter of 20, wow, that's really small print. It's 2018. It's all good. You see a trend in middle of 2022. Guess when ChatGPT was launched officially? November of 2022. You see a downtrend immediately. What if we look at more recent data from Nvidia, perhaps? What are they investing in? AI startups, not enterprise software startups. In fact, they've only invested in 4 since January of 2023, invested in dozens of AI startups. So the money takeaway and chart here is AI's biggest loser. It's going to be SaaS companies. If we just look at total corporate-backed VC deals, you're seeing that AI startups, these two lines cross over. One's going up and to the right. The other one's going down into the basement, folks. If you're a software as a service company CEO, break out your moist towelettes and start rubbing that sweat off your head and your brow, because it's getting hot in here and you're probably going to lose a lot of money moving forward. So, folks, this is a trend we're going to be paying attention to. In fact, we're going to focus on it in the rest of this show with our next 2 guests. It's going to be a key focus. Before we get there, make sure you join the conversation by posting your comments, your questions, your biting criticisms in the chat function of wherever you're watching, YouTube, X, LinkedIn. And don't forget to sign up for our newsletter at thebigskinny.com or scan the QR code on your screen. And now, let's get to this before we get to our first guest. Look, do you believe that everyone deserves affordable access to healthcare, just the normal things that we're used to enjoying and taking for granted here in the United States? Well, if you do, I agree with you. I'm on the board of directors of the Roberto Clemente Health Clinic, and I'm here to tell you that there's a lot of people in this world that don't have equal access to what we have here. And, well, this 501c3 US-based nonprofit has been formed to provide just those types of services in the second poorest country in Central America, in Nicaragua. I can tell you, as a member of the board and someone who's traveled there and seen the work that the clinic is doing and has volunteered with my family multiple times, that there's no replacement for the impact a small amount of money and time can go to really change medical care in a third world country. So again, I know there are plenty of causes that clamor for your time, your attention, and your resources. I'm just encouraging you to check out a new one that could have a real material impact in the lives of people that don't have access to what we have. So I encourage you to check out the NICA Clinic at nicaclinic.org or scan the QR code on your screen, and we'll be right back after a brief message.
Lou, I want to get your take on all things Intel. Uncle Sam's taking a stake.
Yeah.
You saw SoftBank with that $2 billion injection. You want to own Intel here?
No, I don't. Actually, I think in December's goodbye or goodbye segment, I had Intel as the goodbye, like waving goodbye, because turnarounds take time. Here's my thing. I don't generally love the government investing in companies in free enterprise, right, in capitalistic markets. More importantly, with Intel's case, I don't think any government money solves the innovation problem that they have. Intel is struggling to get to the head of the pack in terms of innovation. I think it's because they design and manufacture their own chips. For me, the case gets really interesting if Intel ever spun out the foundry, because then you have the potential to take market share away from TSMC, which controls 70% of chip manufacturing, from the likes of Nvidia. So for me, I don't love this on the principle of the government investing in companies, and I don't love it for Intel specifically, but I got trumped because Intel stock has been reacting pretty positively. Welcome back to The Big Skinny, and it's time to welcome our first guest. I told you before that he's become a fast friend. He's also become a fast beast in the weight room. Man, I got to get on his program, both investing, technology insights, and working out. Daniel Newman, CEO of the Futurum Group. It's good to have you back, my buddy.
It's good to see you. You're everywhere, and now you've got the Big Skinny. So
I could say the same about you.
Show, Big Skinny show. You got all the shows, Lou. I'm just excited to be in your orbit.
Oh man, you're too kind. Listen, let's talk shop, because that's our favorite thing to do. And you have unique insights that I don't think anyone maybe that is in my universe yet understands fully, but you're directly working with the biggest tech companies in the world, which gives you a unique understanding of where their priorities are, where the spending is going to go. And I believe you have some new research out from your company today about AI demand. Is this accelerating? Is it bigger than we expected? What can you share with us today that most people don't know about yet?
Yeah, we put out our 5-year chip forecast, 25 to 29, and it's pretty incredible. It's nearing 600 billion, the AI chip. This is just the data center AI component, not including memory. So if you actually add in the cooling and thermals and everything, we're going to be darn near a trillion by the end of the decade, which is just incredible. But a lot of it's sort of been determined in a way that most of us understand. Like Nvidia is still going to carry the lion's share, but there are some interesting things in there, Lou. Like for instance, we've been very bullish on the custom AI chips, and we know Jensen's not. And I'm an Nvidia bull. Love the company, think it's great. But of course, Jensen doesn't believe that AI chips by custom providers like Marvell and Broadcom and by the way, ARM will be in this space soon enough too.
Look, man, I agree. I think ARM is a sleeper play in the AI chip space. I've loved that business when it went private, and I was happy that it came back public. So good to hear that. So ARM is going to be. Go ahead.
Let me say one thought. The acceleration of the XPUs will actually, according to our research, the growth will be faster by the end of the decade for XPUs, custom chips. And let me tell you why. All you out there, you'll appreciate this. Because it takes 3 to 4 generations of these chips to really start to grab hold. But we've seen what Google's been able to do. And now you've got Amazon, Microsoft, you've got, Alibaba, you've got, Apple's going to come down the pike, OpenAI. All these companies with custom AI projects are really going to start to see the benefits 3-4 years from now. But until then, it's pretty much clear skies for our friends at Nvidia.
So you don't see really a cage fight for XPUs until we get further in the trend. Is that a function of inference becoming more important than just large language model training? What is the driver from the AI side of the technology side that's going to lead to more custom chips versus more general ones?
Well, there's a ton of interest and demand, but you've seen Microsoft kicked its project down the road a little bit. Oracle, there's some murmurs that they're going to do their own chip. Obviously, a huge buyer of Nvidia. OpenAI is kind of threatened to do a chip, and the way Sam creates enemies, he's going to have to make his own. I actually see an ARM Intel OpenAI chip. Just bear with me. That's what I see happening.
Interesting. Well, let's pull on that thread a little bit, because Intel big in the news today, because tomorrow they'll close on that I think it amounts to an $11.1 billion investment from the U.S. government. What's your thoughts on that? You fan?
Yeah.
You anti?
Had to do it. This is existential. The idea that, hey, let free markets reign. I was amazed, Lou, at the number of left-leaning voters that suddenly became.
Bernie Sanders is a fan for it, dude.
Huge free market capitalist. But then at the same time, we have to secure the silicon supply chain. We have to bring the IP here. TSMC is a great company. They're the number 1 company on the Futurum Equities AI 15 list. We think it's monopoly. We think it has control of its pricing. It basically controls the winners and losers of this AI boom. And if China ever decided to accelerate or double down on its aggressions to Taiwan, the United States could become the de facto Taiwanese military, and worse off if they actually were able to successfully attack all of the key engineers that will bring us the next process nodes, the processes beyond, N2, the one that they're building in Arizona, A16 and others, would never make it here. We don't have the IP here. We need a strong Intel.
But do you think this $11 billion roughly investment brings the IP here? I guess my thing is, isn't Intel's problem an innovation problem? Is it not a victim of too much success and then, large behemoths don't innovate as much? Or how do you see this playing out?
It needs to invest to make sure that its 18A and 14A processes succeed. But 14A is competitive with the A16 process, A14 process from TSMC on a spec basis. The difference is we have had the US, Intel has had the brain drain. It has lost too much talent. It needs to be shored up. But again, what better way to shore up a company and create some confidence for top engineers and employees to return than knowing that this company's been basically minted? Like I said, this is the most accurate example of where too big to fail is truly the case. Like the banks, let them burn. But in terms of semiconductors,
come on, dude. I was a banker. You can't tell us to burn, but no, I'm with you. Technology is more critical.
As far as I'm concerned, my friend. I'm just kidding. But in all seriousness, we can't be wrong here. We cannot be wrong here. You're talking about multiple decades to bring in fresh capital and stand up a foundry network. This is not something you can just be like, we've raised a bunch of private equity and we're going to stand up some fabs. It's not realistic. We have to do this. I mean, look at Samsung just trying to even get out of its own way. It hasn't been able to get its own way for multiple years, and it's still struggling right now.
I think that's important distinction because in today's, on-demand everything type of economy and market and world, to understand that building these bleeding edge next generation nodes and technology is a huge capital investment, a huge time investment. So I can concede that. I just struggle with the free market philosophy of the government intervening in business. And how do you know when it's, these were granted as grants first and now you want strings attached. So I struggle.
So hold on. Let's play that out. You and I tend to be on the same side of most political arguments. I think we tend to be conservative leaning on most things. First of all, the grants weren't no strings. They had ridiculous strings attached to them. In terms of things that would have made it almost impossible for the companies receiving chip grants to actually get the talent in the door, like the specific hiring requirements. Again, I'm all for thoughtful diversity. I'm not for forcing it to which you build planes that fall out of the sky or you build fabs that don't produce leading edge chips. So that was part of it. Second thing is, why not have it this is a non-voting share. It's like a sovereign wealth fund investing in a nationalistic interest as far as I'm concerned. Why not allow Intel to be buoyed to build a strong company? TSMC, by the way, 49% was held by the Taiwanese government because they put the first money in, and it's been one of the biggest returns to the Taiwan economy has been the success of TSMC.
Yeah,
so
look, you make a convincing.
Why not let the taxpayers get their money back?
Yeah, you make a convincing argument from that because I can come down on the side of national security, securing, the American capitalistic markets. These are things, this technology is critical to that. I just worry about creep, right? Policy creep that leads, and the president out today saying, well, there could be other companies. And, obviously he can say one thing today and change his mind tomorrow. That's my reservation.
I think it's provocation, Lou. It's like the 15% tax, the export tax on, we might do this with everyone. This is great. I mean, bottom line is they love to leave this kind of open-ended so that if they decide, where else could this happen? Maybe a Micron, a company that's historically bounced between great profits and great disdain because of memory inconsistency. But again, can't do Nvidia chips without memory chips. They're the only US company that can do that. So I know we got to keep moving here, but I actually think of all the policies, the US has never been free markets. It's never been free markets in my lifetime. It's always been, whether it's been AIG, whether it's been the banks, whether it's been the car companies, whether it's been the airlines, they're always buoying things that are considered strategic. There's nothing more strategic than this. You can drive a car if you don't want to fly on a commercial airline. If we don't have chips, we're going back to the Stone Age and we will lose our global economic leadership. So this is existential.
Yeah, you may not realize this, but now this is our 21st episode. We forgot to say that, so we have to take a shot later today for our 21st birthday, man. But more times than not, guests come on this show like yourself and change my mind. And that's the whole point of this, because it's be humble in the market or be humbled. You providing an insight that I didn't think about because of where you sit in the world. So, all right, I'm changed my mind.
I'm here for you, man.
I'm still not buying Intel, but I believe the government investing is not necessarily
By the way,
bad
can
for
I
it.
say one last thing on this one? Because I know we've got a lot of other cool stuff to talk about.
Yeah.
But I actually said there, I'm not bullish Intel yet. I'm bullish USA. I am bullish USA, and I'm not willing to acquiesce our entire silicon supply chain to Taiwan. I'm just not willing to do it. So I'm all for the US. They could split it off for all I care, Lou. They could split it off.
I'm bullish on America pins, buddy. We got them in the studio. You must have left it here last time. How about that?
I'll be on the show with you Friday. You and I are sitting on Fox Business together.
All right, I'll wear this on one side and the I Love Fossil Fuels on the other one. All right, I got to bring up another thing. We kind of disagree on this. Apple of my eye, you had a tweet out that makes me sound like it could turn into a grapefruit here because it's doing silly things. You're souring on it. Apple turning to Google to fix Siri is next level hilarious. Ferrari turning to Porsche to design next generation of race cars. All right, what's so gaff-worthy of this move by Apple? Help me understand.
The people that like to argue with me are going to say they always use other technology. They've been using Google for search forever.
I got to cross that out. That's what I had on my list to say to you. But
okay, I mean, look, AI is not something that Apple can miss. Okay, right now they're basically 100% depending on the fact that their device, this device, the one that's sitting here, you probably have one here, right? I'm an Apple user, wearing it on my wrist. Is this even going to be the device, the actual type of device in 5 years that with AI that we use? I mean, I don't think that's what Jony Ive joined OpenAI to create. Yeah. I think it's going to be wearable. I think we're going to return to having our heads up in society. It's probably going to be something like what Zuck is doing with glasses.
Do you think that gains traction with the Zucks? I mean, they just launched they're going to coming out with their next version of that. It's got a wrist-borne, device that complements it. Do you think that's where we're headed? Small, head-mounted displays that can.
My concern is just that Apple doesn't seem to have any plan if this doesn't work. Like the 2.2+ billion install base, in my opinion, I think I've been very rational about the fact that they have time. But just as every single thing they've tried with AI has been garbage. I can't figure out how a company with their resources can't do it in-house. And our friend Dan Ives, to get him to flip and tell them to go buy Perplexity, do something, that in my opinion was like peak Apple is dropping the ball. Because Dan would defend Apple to any extreme. Like he's like Goldman Sachs credit card, greatest invention ever, for Apple. But it's like, he actually came, and when he came out, I'm like, I'm onto something here. They have to do something. Look, Siri is an abomination.
I agree with you, and I was towing the line as a long-term Apple shareholder from like a split-adjusted price of 40 that, hey, they're never the leader, they're the laggard, they come from behind and figure it out. But I'm like you now. I'm convincing that with the shares they leapfrogged and trade at a premium multiple now for years they didn't. That it's hard to justify buying more Apple at these levels until you see a clear path forward for them in AI. So I give you a hard time, but I'm in your camp on this. But I'm not going to sell my shares prematurely.
I'd buy more Viking.
What's
Viking. That? I'd sell it and buy Viking.
Yeah. See, all right. Perfect segue. Perfect segue here because we've been talking about your biz. I want you to let you talk about your book. Because you have some great trades. You obviously can't invest in the companies that you represent that are clients of yours, but you can invest in the markets. You've been a very savvy investor, except Viking. We both lost some money in that on paper on their GLP-1 pill that I think will ultimately be vindicated. But what are one or two names you love in this market right now?
Well, first of all, I played the options very well on that. I both sold the incredible volatility. I sold covered calls at $145 for $2 a share on my entire position heading into the data drop. And it was an incredible premium for a stock that was at $40 that we're getting $2 on a 145 strike in 6 months out. Less than 6 months, actually. And I also sold a whole bunch of put spreads well below it. And I closed all of them out right before the data drop as well, because the stock had gone up, the premiums had been wiped out, made a lot of actual realized gains. And now I'm holding my position and I went longer. I think the data was pretty good. I think the Mizuho analyst didn't know what he was talking about. And I think the reiterations on the price targets from almost all of the banks at near $100 will vindicate me over time. So far,
I agree with you. I've bought even more. So after the drop, I bought more. But Hey, if anyone else has questions for Daniel, don't be afraid to join the conversation. We're live streaming on multiple platforms. You can throw anything at us. I know from just personal experience here, we can handle it. So don't be afraid.
Yeah.
So what else do you like? Viking you like even after the data, we'll call it a disappointment, short-term disappointment. But what do you love right now in the current market?
I'm a very Munger-like investor. I hold things for very long times. I sometimes play options for leverage on positions instead of ever selling them. Like if I think it's not moving enough, I'll sell covered calls. If I think it's underpriced, I'll sell puts to get more exposure or collect premiums at lower price. So that's my play. I did this with SoFi, by the way, for almost 4 years. I bought my first shares right around the SPAC price of $10, $11, but I rode it all the way up. And I'm one of those guys that owned shares at $25 of the IPOE days. But then about 10% of my position. Then over the next 4 years, I 10x'd my position, buying all the way down to that $4 and change price that it had at the very, very bottom. And I've amassed a position that even some institutions would be envious of. And
well, for people that don't know SoFi, what are they doing that's so disruptive that you have so much conviction about it?
Democratizing finances and doing it in a way that really meets like regulatory. So here's what I'm saying, like they're more of like the Teladoc Health versus like HIMSS is more Robinhood, meaning like they're doing it like, really by the book, they're following all the protocols, but like 90% of people aren't big investors in the market. So they have some financial products, they have some Bitcoin exposure, they have some access to some private products, but also things like loans, student loans, home loans, auto loans, banking, regular, and then doing it all digitally. And then of course, I love Anthony Noto. I just think he's a very measured. He was a West Point graduate. He's never takes the bait from the street. He's not been a champion. I talk about the Vlads and the Alex Karps, the showman CEO. He's not that, but I always knew that this company had potential to be great. And so I'm very long. And by the way, long Robinhood, long HIMSS, long a lot of those kinds of companies too. But I have about 5 or 6 positions. So really, when you kind of hit my book, like 80% of my portfolio, Viking, SoFi, Oscar, HIMSS. What else am I in? Robinhood. And I think that's the majority of my entire portfolio.
Well, let's leave it right there because that's a great way of value add. You got a bunch of stock picks out there. I will say I own Viking. I own SoFi. I haven't jumped into HIMSS. I'm looking at Robinhood, but
the peptide boom. HIMSS.
I know. I gotta get guns like yours before too long. Thankfully, the shot's not wide enough.
Personalized medicine.
Yeah, personalized medicine is the future. I'm seeing it in the biotech world for cancer treatments. The peptide world is definitely bringing it down to personalized wellness. So that's the next topic we'll bring you back on because you've gone through quite a transformation there, which is impressive. If people haven't checked out Daniel's Twitter feed, please go do it. He's the guy you want on your side when you're walking through New York City, going to get a bagel and cream cheese. Because if anyone messes with you, they're not gonna live to see the next day. But hey, man, good to have you again. We'll have you back soon, hopefully, and I'll see you later this week.
Yeah, let's go.
All right, folks, always insightful. And as I mentioned, we're always changing our mind based upon the insights of the guests that we bring on. So always happy to say always a few more always times. But after that, we're going to go to a quick break and bring in our next guest that's got some even more important insights about the software companies that could be disrupted. Please don't forget along the way to join the conversation. Chime in at any time with your questions, comments, or biting criticisms. And don't forget to sign up for our newsletter at thebigskinny.com. We'll scan the QR code on your screen. And we'll be right back after a quick message. Attention investors, are you looking for a high growth opportunity in the energy sector? Well, look no further than Prairie Operating Co., trading on the NASDAQ under the ticker PROP. As America's premier high growth, low cost oil producer, Prairie Operating is making waves in the Denver-Julesburg Basin in Colorado. With a recent transformative acquisition for over $600 million, they've expanded their footprint to 55,000 net acres and increased daily production by over 25,000 barrels of oil equivalent. Prairie Operating is poised for explosive growth, maintaining a strong balance sheet while delivering value to shareholders. Don't miss out on this exciting investment opportunity. Prairie Operating Co., PROP on the NASDAQ. Full disclaimer, I am an executive at Prairie and deeply conflicted. And, of course, past performance does not guarantee future results. So consult your financial advisor before investing in Prairie or any other stock mentioned on the show. We'll be right back.
Let's get a quick check on shares of Opendoor, spiking nearly 40% on the day. It's one of the top trending tickers. Lou, your take on the move in this name. You bought into this name, Lou. You are a believer.
I am a believer, but I think this is based on Powell and interest rates, right? I had Eric Jackson on my podcast. Before he even started getting out on Opendoor, we were talking about the names in the Bitcoin mining space that pivoted. He does his work. He is a very fundamental.
We had him on the show, and he does his work, and he makes a strong, compelling case.
Yeah, it's a real estate rebound play, and it makes sense to me, right? Interest rates come down. The real estate market is the one thing that's dragging back this economy and the market. There's a fear there that it's going to really pull things back. Now we get the hope of interest rate cuts. It makes sense that it's rallying this high today on the fundamentals alone.
Do you put Opendoor in the meme stock category? Because I think, correct me if I'm wrong, doesn't Eric Jackson say no, it's not a meme stock?
No. I'd say no, but it's meme-like because it's leveraging.
What do you mean by that?
Meme-like to me, a meme stock has no fundamental basis for rallying, right? There's not a fundamental value to the business. It's just like when AMC was running and no one wants to go to movies anymore, or GameStop, no one's doing video games. But with Opendoor, there's a real estate business there, but it's attracted the retail audience, which is now a bigger contingent than ever, right? It's a force that has to be reckoned with. They actually got a CEO to resign.
Remarkable.
So, retail investors account for now upwards of 32% of daily trading volume. Long-term average is 12%. If you look at the options market, they're now 30%. So this is a change, a paradigm shift on Wall Street that the C-suite now has to pay attention to. So interesting times we live in.
Got to stop and listen. All right.
Welcome back to The Big Skinny with Lou Bassanese. If you were watching that clip right there, you saw and heard that I am actually an Opendoor shareholder. Eric Jackson was a guest of the show going back a couple months ago before he got into Opendoor and went on a huge social media campaign to engage a lot of retail investors. Some people labeling it a meme stock. I shared there on Yahoo Finance. I don't think it is one. I think it has meme-like qualities in that it's attracted a crowd of retail investors, but there are true fundamental reasons and value to own it. I'm long Opendoor from about $1.50. I do believe it could be a 10 or 100 bagger in this market, which after all is what we're always looking for. And interestingly enough, our next guest, who used to be a colleague of mine when I worked for Public Ventures and MDB Capital, really sits at the epicenter of spotting trends early and finding tomorrow's 100 baggers and more by focusing on deep technology. So I want to welcome in Will Rossellini, the Chief IP Officer at PatentVest. Will, good to have you back on the show.
Hey, Lou, thanks for having me.
Yeah. Listen, last time you were on the show, we were talking about the humanoid robot revolution, and you had some really interesting insights by looking at the patent filings. For people that don't remember or aren't aware, PatentVest has one of maybe a handful of globally translated patent databases that give you really unique insights and MRI into what's going on in the innovation world. What are you seeing now? You have a new report out that's coming out, I believe, later today or tomorrow on AI disrupting software companies.
Yeah, we're looking at the patent literature because that's the best way to determine what people think is important, because they're investing and paying money to get these patents. So a lot of times academics will publish journal articles just to publish them, but not necessarily value them. They're doing it for publication count. So we look at the patent literature and we look at activity. And so we take spaces that we want to become functionally expert in and go really deep and track the activity from quarter to quarter. What you'll see is essentially a dramatic spike in what you'd call machine learning, automation, or AI. And that spike goes in pretty predictable paths. You can look back at the news and kind of see when it becomes cognizant. In 3 or 4 years before that, you see the spike in patents.
And is it uniform across countries, or is it growing in certain countries more than others? What are the trends you're seeing, globally versus just domestically?
Well, the U.S. has about 2/3 of all venture capital funding, so it's had a lot of activity, consistent with what's been done in the past. China's second, and then Europe third. But China has had an enormous amount of filings relative to their historical context, and so they're actively looking to protect, especially in China, which is interesting. Previously, they took a more worldwide strategy.
Yeah, where do you see the opportunities and the threats, right? We start talking about here, I think with chart that you have shared in your report, the difference between US and China is that the average patent citations is much higher in the US for US patents, 13.2, which is an indication of uniqueness and value. even though the U.S. is behind in total patents filed. How would you interpret this, and what are the takeaways you see from this data, and what's on the horizon for software companies?
Well, what's really interesting is if you look at the sort of LLM's ability to achieve AGI or ASI, superintelligence, ASI superintelligence, I'm not a believer that LLMs will get us there. And so if you take kind of a neuroscience-inspired approach to thinking about where these LLMs to get to consciousness, you need more electricity than we can produce the entire world. And so that trend, the shortage of chips and the shortage of electricity, is going to prevent an LLM-like consciousness from emerging. Are these really important tools? Absolutely. What we see happening in sort of the next 5 to 10 years is this disintermediation of software. What I mean by that is it's so easy now to create software that the ability to have a moat based on getting lots of users and driving more advertising, like it's been over the last 15 years, the Facebook stories, the large stories like that, those are largely going to go away as that becomes more commoditized. What's interesting in the report is what we see happening with LLMs is they'll be put into the physical universe via robotics. And so you'll see a leap from software-based AI and LLMs into robotic-based artificial intelligence, and that's a really big game changer.
Yeah, how far away do you see that future? I mean, we had Chris Camillo on, who's deeply invested in humanoid robots, and he was saying that it's not within 5 years that you're going to see armies of humanoid robots deployed in people's homes, but it is going to scale pretty quickly in the next decade. Where do you see that happening, that jump and miniaturization into the robot space?
Yeah, what we see is more of a trend towards patents becoming potentially less and less valuable because of the way that the software can write these patents. We see that trade secrets are going to become more and more important. But we see what we call deep tech areas like robotics, which are physical, science-based or engineering-based innovations, becoming much more important. And so when you think about deep tech is basically this concept that you have to have a fundamental leap in scientific experiment or an understanding of the fundamental engineering physics. Once you start to move AI into the physical universe, humanoid robots are certainly one, but that physicality is going to start to be a really interesting investment phenomenon because the high margin software is really uninvestable after a certain period of time. Number one, you won't be able to get patents. And number two, if you do, there'll be so many other patents out there that it'll be difficult to really differentiate and protect a moat.
Yeah, and are you seeing the funding trends already mirror this change in paradigm shift away from software, traditional non-deep tech into more deep tech venture investments?
Well, what I'm seeing is sort of twofold. One is this the traditional venture capital model of company development is deteriorating, albeit there's not a replacement yet. So we see this concept of a venture studio where the investors are closer to the operations and thematically more interested in certain segments that they can build companies at scale. So I see that trend. I don't necessarily see more of an investment trend yet, but you're seeing in things like robotics, some of the other deep tech areas, DoD spending, for example, is going up. Biotech is traditionally a deep tech investment, but biotech has not done well over the last 12 to 18 months. Yeah,
we know that. I know that all too well. Too many names, very innovative, exciting things that are actually saving lives, but their equity returns have not caught up to the real life returns. Tell us a little bit about, too, you guys have been very just innovative on your own in terms of sussing out these insights using the PatentVest database. You're coming out with a report, honestly, I think it feels like once a month that's giving you unique insights. What are some of the other cutting edge? I believe you had one recently on quantum computing. What was the takeaway there? Because that's a hotly contested space in the markets, financial markets now, because there's a whole camp that thinks quantum computing is going to be here much sooner and they're bidding up these stocks. And there's another bear camp that says it's not coming anytime soon and quantum could disrupt and do an end around on cryptocurrencies and bring an end to that market. What do you see in quantum, and what are there some other technologies you're really keen on right now?
Yeah, my opinion on quantum, based on the patent literature, is there's still an enormous amount of approaches that haven't had fundamental breakthroughs that make them viable yet. So there's lots and lots of experiments and lots of work. Very difficult to predict who's going to win because it really is an unpredictable art, especially in the quantum world. So that's what you'll find in that sort of patent literature is a very broad scope of what we call experiments or testing the fundamental engineering. Where we see, where we've been surprised is in some of the deep tech companies that are getting, multi-billion-dollar valuations in the hard tech, deep tech spaces. They have very limited patents or patent filings, right. And traditionally we would have looked at that and said, well, there's a valuation gap that's going to be coming because if you don't have those areas protected with patents, you're going to be in trouble. Elon Musk, for example, is notoriously, kind of anti-patent and has been that way for.
Yeah, he likes to share the patents, right? I mean, famously, he was doing that with Tesla early on. I don't foresee that many people following that lead, though.
So I thought about that a lot. Why did he do that? Certainly Neuralink hasn't followed in the footsteps, and they have enforced patents that they've gotten. So it's not necessarily a philosophical approach that he's pro or con patent. What I think he might be quite clearly focused on is patenting activity might be less valuable, and he might be protecting things like trade secrets in ways that is
just doesn't
way
want
more
to reveal it to the world. Hey, we got a question here before we direct people to your website to get the latest reports. Do you have any opinion here on crypto's the last issue quantum will disrupt? It includes quantum disrupts everything, including national defense, right? I don't have an opinion on this. I'm not as smart as you. I think you have 3 PhDs, made it to the major leagues for 3 or 4 companies or teams. So I'm going to let you take this one.
Well, I live in Dorado, Puerto Rico, which is a very interesting place to live and to have owned no crypto since inception. So I'm certainly not a crypto understander in terms of how to make money.
All right, well, we're going to leave it there then. Forget that. Neither of us have a good answer. And see, look, folks, when we don't know, we won't respond. We appreciate you joining the conversation. Will, I appreciate you joining again. I want to direct folks to the PatentVest website. If you go there, there's a reports tab. You can see the latest research that PatentVest is putting out. I encourage you to do it. People, there are no one else putting out insights like this. Scan the QR code on your screen. Sign up for their newsletter that comes out regularly, and you're going to be a step ahead when it comes to the earliest, biggest potential technologies in the market. Thanks again, Will, for joining us.
Thanks for having me.
All right, folks, we're cruising right along here in this latest, the 21st episode of The Big Skinny. I want to give myself and the team a round of applause because that's quite an accomplishment. We started this not knowing what it was going to turn into, and hey, we're still trying to figure that out, which brings us to the next segment in the show, in this long line of innovation. We're bringing in the Dodd man for a new segment. We tried to tease it in the go, but it's called Dodd's Got Questions for good old Lou. Dodd, why don't you tell us what this segment's about? And welcome back, my friend.
What's up, Dodd?
Hey.
Took a minute, but I'm here.
You are here.
Before we
what
jump
do you
into
do? Were you outside playing flag football before you came on? Like, what's going on?
No, brother, there's a lot to unpack here today. So, I'm celebrating the first week of college football, and my Knights are playing on Thursday night to kick it off. So, I don't know why you don't have your blue and whatever.
I have black on for the Knights, apparently. I'm being simpatico with my brother in arms here and supporting his team before the Gators play on Saturday against, I think, the School for the Blind and the Deaf, which is usually who they play the first game of the season for a win. So.
Yeah, well, I think the Knights are doing something similar, and who knows if we're going to win or lose this game or this year. So I'm just crossing my fingers.
All right, so we're rolling out a new segment here. Dodd's Got Questions. Tell me about
You're jumping ahead, man. It's 24. Where's your bourbon? This is 21. I just want to celebrate 21.
Well, while we go get that to celebrate, my friend.
All right, you want to get to business. So anyway, here's the deal. We've heard a lot of positive feedback from viewers that appreciate when you break things down, and today's episode is no different. There's a lot of, I don't say jargon, but a lot of, bigger finance talk words, in this episode. So, a lot of viewers want to, like it when you speak in plain English. So
All right, so this is going to be a segment of the show where anything we had in the interviews that might not have made sense, that people might have been afraid to ask a question about because they're too much of a novice or it was going too quickly. You're going to put a finger on that pulse and ask me and pepper me with the question, and hopefully I can answer it in plain English and bite-sized, understandable terms.
Well, we're going to find out. So while you were interviewing Daniel and Will, I was writing down some things here. So some good questions that I had questions too. So you were talking about inference with Daniel as it relates to AI. Now I understand inference as it relates to an earnings report, that if a company's supplier reports lower sales, investors might infer that demand for the company's products is weakening. Can you explain further how inference relates to artificial intelligence? Because that's definitely off the reservation for me, the two connecting. Well, but even more importantly, how does it affect stock price?
Yeah, well, that's a good. Well, one, you're not that far off the reservation, because if you're inferring from an earnings report what might be true, you're taking new information and trying to decide what the impact is somewhere else. And that's really what we talk about inference with AI, right? The early days of AI was training the models on data. Inference is when that training has already happened, the AI model has seen so many patterns that then you can then introduce new information that they've never seen before, that this AI model has never seen, and it can infer or make predictions based upon that new information and the pattern. So it's basically the AI working and predicting and taking in new data on the edge that doesn't need to be trained to do. So it's the next evolution of AI. Obviously, if you think about this, when we move from a world where people are putting inputs into AI, querying to cheat on college exams and things like that, to a point where AI is just always constantly sensing and taking in new data inputs and making decisions and predictions, maybe perhaps based on the weather, it's going to generate a lot more demand for AI compute power, for chips. So to your second question, what does this mean for the AI trend? It means all these chip suppliers are going to be in much more demand than we think. And I would tell you this, most technologies, people overestimate their impact in the short term and underestimate them in the long term. I'm going to tell you that I think AI is going to be the one trend that paradigm shifts it, where we underestimate in the short term and underestimate in the long term, because there's going to be so much demand for compute and all the ways that we use AI moving forward. So great question.
All right. Don't know if I'll pass the test yet, but I'm definitely on my way. Appreciate that. So, all right. Question 2. So you've said about the Mag 7 making up about 38 to 39% of the S&P 500. And, I've heard, big tech having that much hold on the S&P 500 could be a bad thing. Now, I understand from an investing standpoint, putting all your eggs in one basket is not, a smart, just smart thing, smart strategy. Right. But does that keep you up at night? What do you feel about that? What's your take?
Yeah, so I think there's two questions there. One is what is 38% of the index? How does that happen? And it's because the index is a market cap weighted index, which means that there's 500 companies in the S&P 500, but the index isn't comprised of 500 equal investments or parts of each company. It's actually based on each company's size. So the bigger the company, the bigger the market cap, the more weighting it has in the index. And so the fear by many is that because the Mag 7 makes up almost 40% of the index, is that however they go, they're going to impact the performance of the entire index. They just have more of an impact. Think about it like a piece of pie, and you have slices that are not equally cut, right? Well, that's what you have there with the Mag 7. So let's say, Nvidia is the biggest piece of pie in there, making up 8% of the S&P 500. If Dan or Taylor in the studio go and eat that piece of pie, now that performance is gone and out of the performance, right? But if we eat a little sliver, we just steal a pinch because we're on a diet, because we're the big skinny, it doesn't have as much impact on the price performance. So what you want is really an equal cap weighted index, which there are ways to invest in the S&P 500 in an ETF that's equal cap weighted. So that way, if one stock goes up, and even it's got the smallest market cap in the S&P 500, but it goes up 100%, you get the benefit of all of that. But by the same token, you get the detriment if it goes down the most. So yeah, that's the difference there. And in terms of, I don't remember what your second question was, so it doesn't really matter. So let's move on.
No, that was it. That was the second question. So no, that's good. So hopefully, let's get some viewer feedback that they like, these questions, and, let's do more in the future. So
yeah, no, look, I think this segment is intended to sometimes we forget that we may be talking in a way that is not understandable, even though we try to. So we encourage everyone along the way. We're always live streaming on social platforms. You can chime in by just punching a question into the chat box. With that being said, I think we're closing out and getting to the high five for the week, if I'm not mistaken.
Let's do it.
All right, bro, I'll give you a toast now. In that commercial break, I was able to pour myself a small one. And, when we make it in the big time, we won't be able to do this on live television because you're not allowed to drink on air, I don't think. So cheers to you. Cheers to all our loyal fans, supporters for 21 episodes and 2,100 more to come. Let's go, baby. Let's hit the high five. What are we talking about?
Not doing a victory lap yet, but let's celebrate the small things at least, right?
And the short things. Lou Bassanese.
Hey, I have to say, did I make it to the C block? Because there's no D block today.
There's no D block. The D block is gone. You've been elevated and promoted once again, my friend. Don't screw it up.
I'm on the way up. All right, let's jump in. No pain, no more gains. The only thing I got on this is you were talking about your fitness regimen again. So did you try the intermittent fasting? Come on. You got to give it a shot.
I did try intermittent fasting. I don't love it. I don't think it works. I think as you get older, it's wellness diet matters more than time in the gym. But no pain, no more gains. I don't remember, dude. I've officially kicked this off. I've got to cheat. Oh, now I remember. It helps when I've got little side notes, but no pain, no more gain. Look, housing market has been a huge expander of wealth in the last decade. But now if you look at the latest data, 39 of the top 50 metro areas in the United States experienced month-over-month price declines, right? So I think there's a rebalancing that has to happen in the real estate market. It will definitely help when the Fed cuts interest rates, but everyone's got to get, square up with reality. The real estate market got way ahead of itself. So, no pain and no more gains until you go through a little more pain here. So you're seeing sellers markets pop up everywhere here, and this data is instructive of that.
Housing market, no connection there. Had no clue on that one. That was.
I mean, look, you could be a day laborer and you're getting an exercise while you're working too. I mean, that could have been the fitness angle of it, but which I did do. I built homes in Florida, hammering hurricane straps on every 2x4, top and bottom stainless steel. I learned how to hammer with both hands, so left and right ambidextrous for $5.05 an hour under the table.
Wow.
It sucked. Almost as bad as pumping gas in New Jersey as a 16-year-old. So, moving right along.
Speaking of pain, I thought you were going to throw fists with Daniel there, and brother, you're going to lose. I'm telling you right now.
Oh, dude, I'm telling you, you saw his picture on Twitter. He's gotten absolutely jacked. So, kind of like the Jersey boys I grew up with when there may have been gym, tan, laundry, and steroids, but I won't.
All right. Well, anyway, consumer shakeup. There's another one. Just no clue, but Starbucks, already out of pumpkin spice. I mean, they've started their fall lineup in August, which is ridiculous. But
I know Unite fans live off of pumpkin spice lattes, but us normal folk here, consumer spending has traditionally has traditionally been the engine of the U.S. economy. And we've talked about this a few times on the show. This is the latest data point showing that consumer spending and spending on data centers is now about equal on the impact on GDP. So if you took a rolling average of the last 2 quarters, consumers have generated about 0.5 percentage point of GDP growth, and so has data center spending. So watch out. AI trend is here to stay, a bigger contributor than anyone's thinking about.
AI is just everywhere. All right. Cheater. The only thing I got here is it's got to be a stat about Coldplay concert ticket sales or something.
Well played, but no, it's actually about ChatGPT. Guess what happened when all the college students went home for summer? ChatGPT usage plummet. So this is indicative of the first wave of use for AI was cheating. I think it's now being integrated into educational system in much more constructive ways. So I'm told by 2 of my older children that are in the education system.
And that's for real?
That's for real. What, you think I painted this pretty picture? You're the design guy, not me.
That is crazy. All right. Profit pivot. We have to be talking about my portfolio again. Let's hope it's in the right direction.
No,
Dude,
look,
you're
we're
leaving nothing on these for me.
I know this is I'm testing your knowledge. Profit pivot. We've talked about small caps, large caps, growth versus value. Right now, the Russell 2000 is comprised of more unprofitable companies than it has been in a long time. So, what's the takeaway? This index, small caps are getting ready to surge. The best way to find the biggest potential investment winners is to focus on those companies that are going from losing money to actually generating a profit, because they will have the most pronounced moves in this next upswing. So we will be looking for those to feature them on the show is the net takeaway if you don't want to do the work.
All right. Is that a Bitcoin in my pocket, or are you just happy to see me? The Bitcoin Bowl.
See, I set you up there perfectly. Look, Bitcoin becoming 2% of global money supply is a big deal. We've talked about this, Tom Lee of Fundstrat saying never has anything in the history of the financial markets grown to 2 trillion in assets value and then gone away. So Bitcoin's here to stay. Get used to it. Stable coins are going to lead to greater adoption of cryptos. So we're closing out, and we've got a game that we were playing here that no one knows about, Dodd. I hinted at it at the beginning in the waning minutes.
It's been too long since we've had a game. Dodd needs a game. We have to have game through it.
All right. Do you want to tell everyone what the game we were playing? You came up with a slide.
I'm going to let you introduce this.
All right, so for those that didn't know or that joined us late at the beginning of the show, we said we're going to play a game throughout the episode. We just weren't going to tell you what it was, and Dodd came up with this catchy graphic that we were playing Lose Clues. So what is this? Well, this may not be a game I've played on national television before with friends, where my friends give me 5 random and sometimes moderately hard words to work into my comments naturally throughout the show, and that's what Dodd and friends did today. These words, maybe you were probably scratching your head going, why the hell did he talk about a bagel and cream cheese, or apple turning sour into a grapefruit, or Mr. Snuffleupagus of all things, or the moist towelette that you use to wipe your forehead and brow because your software company is going into extinction. But here's the news. I win the game, Dodd. You lose. I work them all in. That's the net takeaway here. The challenge is going to be here every week. So, folks, if you've got a word you want to hear me work in, email it to Dodd, D-O-D-D, not the Department of Defense, the extra D on the end, D-O-D-D at thebigskinny.com, and he'll surprise me. He doesn't give me these words until about 30 minutes before the show, so I can't plan ahead. It's spontaneous. It makes it more interesting, because how often do you hear financial news and commentary that references Sir Mix-a-Lot, I like big butts, and grapefruits, and Mr. Snuffleupagus. So that's it.
Congratulations, brother. That was impressive. That was very impressive.
Well, so is joining you for 21 episodes and at least 21 more to come, and to the team, Taylor, Dan, Sam, David, you, Dodd, and me. We'll be back with the Big Skinny, probably not next week because it's Labor Day. We're thinking maybe Tuesday, but look at your email inbox. Happy Blackjack. Great stuff. I dig the show. Chad Towers, appreciate you. Sorry I missed you at the Entercom conference in Denver, but next time we'll catch up with you. Chad's got more compliments here. Hold on. I'm going to hang on for a compliment. I will be intrigued to learn more about Viking. I did go long SLB via Kenny Polcari alongside other oil companies such as Prop. Glad to have you. Yes. Well, look at the latest filings for Prop. Mr. Chad, you see some insiders buying. I've been one of those as well, but I'm not a filer. But other insiders are filing and making meaningful purchases to demonstrate our commitment and belief in the long term of the company. We thank you for your commitment and belief in what we've got going here, and we'll see you on the next episode of The Big Skinny.
Cheers, Lou.
See you, buddy.